Money Makes You Think. Hi, I'm your host Aditi Anand, a teenager who frankly has a lot of questions about how finance works. Today, we're going to be talking about a series of unfortunate collapses, Part 2, Signature Bank. If you haven't already, make sure to check out Part 1 of this series. A series of unfortunate events, Part 1, SVB. I think when you get to understand what happened with SVB, you'll start to see a lot of patterns here and there with what happened with other mid-sized banks like Signature Bank that we're going to look at today. Now, Signature Bank is a little more interesting, I can say, than what happened with SVB. And while maybe SVB was probably all over the news when it collapsed, it's helpful to sort of take a step back and look at what other smaller banks did and how they still ended up being affected ultimately by SVB's collapse. I'm going to be narrating Signature Bank's story using 4 different parts as well as a short introduction. Signature Bank, the third largest bank failure in US history, just 2 days after the second largest, SVB, collapsed. So, a very short time span between both of these events. Signature had just been running over 2 decades, and although was just half as young as SVB, it served a very different set of clientele, actually targeting a couple of different markets over its short tenure. In today's podcast, we'll explore how some of these strategic decisions cost and benefited Signature, and maybe things that they did even better than SVB to lessen this ultimate consequence. If we actually pull up the loan portfolio that the FDIC recently put up for sale after the collapse, we see CRE, that's commercial real estate loans, commercial loans, and some single-family residential loans. CREs are loans made to businesses instead of individuals, and they're usually long-term, around 5 to 20 years. And most of the ones that Signature made were for multifamily properties, for example, apartments in New York City. So it wasn't surprising at all that real estate made up 1/3 of their total lending compared to just 1/20th in other comparable banks. What's more impressive than their portfolio was the fact that they had numerous achievements, including being on Inc. 5000 list of fastest growing companies and America's best banks to work for in 2019, even extending its help to community, awarding $500,000 in grants under its Building Improvement Initiative program to 5 nonprofit housing developers. However, just like the SVB story, things didn't work out with all that turbulence in the market. Especially in the sector that they worked in, Signature was prone to controversy. Here we go. Part 1, Landlords and Taxi Medallions. Having lended to New York's worst landlords, aka notorious evictors and profiteers of deregulation, according to a report in 2017, their image began to turn sour. By 2018, they were also well aware that they exceeded the risk that bank regulators recommended, and with changes to tenant laws which made it harder for landlords to profit from deregulation, and remember that landlords were just Signature Bank's clients, demand began to dry up. So, just like any business, they pivoted. How? By diversifying to more unconventional markets, like heavy equipment lending and providing loans to cab drivers to obtain permits called taxi medallions to let them operate in New York City. The latter became another problem. Competition started to soar from app-based services like Uber and Lyft, who didn't need to get million-dollar medallions like existing cab companies had to. And the bubble burst. The one from wealthy owners artificially driving up the price of medallions. So while that side of their business started to break and crumble, it began to reveal a lot about the existing way that this sector operated. A series of unfortunate events indeed. Part 2: Risk and Reward. One of their other risky ventures that did surprisingly become successful was crypto. In 2019, they launched Signet, a payment network for crypto clients that operated 24/7 and witnessed a surge in deposits, earning its place as the second most used interface between crypto and traditional banking services. There were two features to Signet. Number one, they required a minimum deposit balance of $250,000 and were FDIC approved. P.S. You'll notice a red flag about this if you watched the previous SVB episode. And number two, FTX transfer deposits made through Signet were transferred to Alameda Research. Part 3: Classic Run on the Bank. So, Friday, March 10th, 2023, Signature's customers panicked with the whole SVB ordeal, and so they withdrew about $10 billion in deposits. And it didn't stop there when they realized that SVB's problem with uninsured deposits also applied here. For context, for Signature Bank, it was 90% of its $88 billion in deposits, which were uninsured. All about the FDIC limit. Ring any bells? So a run on the bank caused a 60% decrease in this bank's deposits since the start of the year. We saw the same thing with First Republic Bank and other regional mid-sized and niche banks. There's actually an index called KWB that tracks the top banks, and it fell by 10%. Executives all inside the business remained calm against the weekend storm, looking at ways to raise capital, a bit like SVB, or at least find potential acquirers. But by Sunday, they were confident that they were going to see clear blue skies. Little did they know that on Sunday, regulators would announce that Signature was being taken over. Part 4: Looking back to look forward. The government assured that by Monday, just like with SVB, customers could have complete access to their deposits. How? By invoking the systemic risk exception. For this, we're going to need to take a quick break for a history lesson. In 1950, Congress, which is the part of the US federal government that passes laws, said that it would limit bailouts, but that FDIC would be able to help them if they were essential to provide adequate banking service to the community, aka the essentiality exception. In 1991, they said FDIC introduced the least cost to taxpayers method in the event of a banking failure. The exemption was if a bank posed a systemic risk wherein it could have serious negative effects on the economy if the first method, the least cost method, was used instead. Systemic risk exception has actually been used before with Wachovia, Citigroup, and the Bank of America in late 2008, although Wachovia and BofA didn't actually use the SRE package since Wachovia ended up merging with Wells Fargo and BofA said that they wanted to minimize reliance on government support. There were bailouts used to stabilize the economy then, which people weren't so happy about because it was essentially money that people paid as tax to the government for public development, instead being used to bail out these banks. So the Dodd-Frank Act was created in 2010, and among other things, it said no more to bailouts and yes to the least cost and systemic risk in the event that it is necessary. Oh, and also, if you're wondering, the money came from banks paying the government to conduct stress tests. So now you don't have to worry about your tax paid being used for something other than public development. That's it. Thank you for watching this episode of Money Makes You Think. Hopefully, you got to learn a lot about the collapse of Signature Bank and how that contrasted with SVBs if you listened to our previous episode. If you like this episode, make sure to watch some of our episodes from season 1 where we get to dive into the more fundamental topics of finance in our world. I'm Aditi, and I'll see you in the next episode. Bye!